All right, welcome to the stream, everybody. My name is Kyle Seagraves. Here with me is Dan Frio. And Dan and I work together. We're both federally licensed loan officers. We work under ServBank. And what we're going to do on this stream is we're going to answer your questions, and then also talk about a few things that are causing people to kind of wait out the market. And so we want to get your ideas of are you waiting on rates to lower, home prices to lower, waiting out the election, the Fed funds or the Federal Reserve meeting, or even the NAR settlement, and seeing how that pans out. So we'd love to hear from you on that. We'd also love to know where you're looking at buying. Go ahead and put that here in the chat, so we can see where you're taking a look at purchasing. Feel free to just put a state if you want to, or a city. And Dan, you want to get into what's going on with rates and some economic news?
Sure, dude, you're good at this. I love how you just flow right in there. He was telling jokes right before we went live. That's why we're both laughing.
Right, so we could have that picture perfect start with a laugh.
Okay, so what's going on right now is everybody's waiting for what the Federal Reserve is going to do, and it's basically going to be determined. They're going to cut rates. Okay, let's keep it at that. They're going to cut rates. How much? Now that's the issue that's coming. So this week's jobs data. Kyle and I were just talking about this. If you guys watch my videos, I use the CME FedWatch tool basically every day, and a lot of people are like, Dan, can you quit? But I want you guys to understand how this thing works. So I'll get to this in 1 second, but and you keep it up if you would though, Kyle. So what's going on right now is even the former Fed officials are coming out, and they're coming in saying, yeah, the Fed's going to cut. Okay, now it's being determined by the jobs market. Okay, so the jobs report that's coming out this week is huge because the Federal Reserve is they're meeting in, I think, a week and a half. So the jobs number that comes in this week will be the last jobs report, basically, that we get until that meeting. And here it is. So here's the economic calendar for the week, and this is the data everybody's waiting on. So you're most likely going to see the equity markets. When I say the equity markets, I'm talking about the stock markets. Like the Dow Jones, the NASDAQ, and all those. What everybody's poised on right now is I think the markets are going to be completely flat until you're going to have a jobs number out tomorrow, and that's ADP. I don't like ADP's numbers. They're usually not very good. They changed their model about a year ago, and I keep watching it, and they're hit or miss, I guess, is the basis points on that. The last couple readings they've been doing very well. So, and you can see tomorrow's news is basically the ADP payroll numbers, initial jobless claims. Those are the two main important pieces of the puzzle we're going to get. And then on Friday, that's the number. This is the employment report everybody wants because this is from the U.S. government. They're going to give us what the non-farm payrolls are, what the average hourly earnings are, and what the unemployment rate is. Now, what you have to remember is about a week ago, all of a sudden there was two investment firms really diving into the jobs reports. And when they dove into those job reports, there was like 800,000 like automatically gone. So the unemployment rate should tick up just based on that. Okay, so now what you're seeing on the screen, this is what's called the CME FedWatch tool. A lot of people talk about it. I've been talking about it for years. Basically what they did, the CME is this Chicago Mercantile Exchange. They have this tool, which is right here, and this is what's the probabilities of the Federal Reserve changing or modifying the Federal Reserve's or the federal funds rate at the next meeting. So along the top that you're going to see that you have numbers, it starts like 200 to right where Kyle is right above there. You're going to see 500, 475 and things like that. Okay. Those are percentages. So all the way to the right, you're seeing 500-525. That's actually an interest rate. It's 5% to 5.25% interest rate. Okay. So what this chart represents is the federal funds rate. Right now, the federal funds rate is 5.25 to 5.5. It's already off the sheet. Okay. One of the things when we went on live, I'm gonna tell on you, Kyle. Kyle jumped in and said, "Dude, did you see that they changed the percentage or downward on the federal funds rate of 500, 5 to 5.25? It changed a little bit." And we're looking at that, and then I'm like, oh, here's why. Because now they're pondering that the Federal Reserve might cut rates a 0.5%. So now there's kind of almost a 50-50 chance of what the Federal Reserve is going to do. Are they going to cut 1/4, or 50 basis points. I'm still the proponent of a quarter cut. But if the jobs numbers come out on Friday bad, like real bad, not with, with their estimating, but bad, they're probably going to cut 50 basis points. Unless that happens, they're going to cut 0.25%. They're not going to cut 0.5% unless there's something that's just out of the ordinary. Because what they don't want to do is they don't want to signal to the markets, oh boy, we got major problems. We got major problems, because that then is going to freak out the markets. They're going to say, okay, now there's a recession and so forth. So I don't think they're going to do 50 basis points cuts unless there's a bad jobs numbers. Now, one piece of the puzzle that a lot of people talk about, and Kyle and I talk about this a lot, is people are waiting on the sidelines for the Federal Reserve to cut. Okay, and Kyle, what was your analogy last week? And I'm like, that's genius. How it was like basically people trade on the rumors, and then once it happens, it's over with. What was your analogy last week? You remember?
Yeah, it was so let's say Tim Cook, CEO of Apple, comes out and says, in 2 months, our financial statements are going to come out and they look terrible. Well, Apple's stock isn't going to plummet in 2 months. It's going to plummet as soon as that news comes out, because markets are all based on speculation of what's going to happen in the future.
That's it. Perfect. So what's happening right now is exactly that. The Federal Reserve has said, we're going to cut rates. So now rates are coming down, but they're kind of just stagnant right now because they're waiting for more data. And that more data now is the employment numbers. Okay, that's the data, and the Federal Reserve has said it. And if you watch my videos on a daily basis, pretty much every day I'm putting in on a Fed official or a former Fed official talking about rate cuts. Every one of them, basically every one of them is saying, yeah, they're cutting. So they are going to cut. It's just at the point now of how much. So that's basically where we are with the economics behind a lot of this stuff right now.
I think the frustrating thing is people see this and these numbers are so close to where we're at with mortgage rates that they think, oh, okay, well, if I wait until September, then rates are going to come down to 5% or 5.25%, or they might even go down to 4.75. And like Dan mentioned, this is the federal funds rate, which is the rate at which banks effectively lend each other money, not what the mortgage rate is. And I think the hard part is people see, the Fed funds rate has gone up and mortgage rates are up, so they think they're the same thing. And we did this last stream. We talked about the federal funds rate in blue, which is really frustrating to see on this chart because it always grays out when I hover over it. But it's in blue and mortgage rates are in red. And so I think I talked about last week that article that was saying, well, the Federal Reserve, we expect them to cut rates by, let's say, 0.25 in September. So mortgage rates are going to come down 0.25. Just subtract your mortgage rate minus 0.25, and that's going to be the new rate, which is not true at all. Just like we talked about my cat's playing with a box over here, so I'm a little distracted. So we were talking about with the analogy with like the Apple stock, is that news about the federal funds rate decreasing is already baked in. It's already been talked about. It's already traded in the market that way. So rates already have that kind of priced in, the rate cuts priced in. And they don't go exactly hand in hand. Rates and the federal funds rate right now are primarily where they're at because of inflation data and jobs data. That's what they mainly change based off of, is how the economy is doing. The federal funds rate is just like the brake pedal the Federal Reserve has to slow down the economy. And so they see inflation go up, for instance, or they see a decrease in unemployment, or maybe it'd be easier to say an increase in employment, makes that less confusing. Then the Federal Reserve, if inflation is high, they kind of increase the federal funds rate to put the brake on things. So all that to say, when we've seen in the past, the federal funds rate go from 6.5% all the way to, this is about 1.8%. Mortgage rates didn't drop that drastically. It took a decline here, but that's because of other economic factors, right? So around this time, likely what happened is there was also high inflation. As inflation came down, mortgage rates started to come down as well, but it's not dramatic with the Fed funds rate. And so I know a lot of people in articles are talking about it's going to decrease exactly on when the meeting happens, but that's just a little too oversimplification, and that's not how it works, unfortunately.
Cool. So that's basically the economic news. We're all just waiting on the employment data to come in, and you're going to see stocks move along with that as well.
Party UV5 said, what the unemployment rate doesn't tell you is the people who ran out of funds and still can't find jobs. I know 5 people with degrees that ran out of money, and the economy is financially killing them. Yeah, it's tough.
I'm going to just conversely on there. There is a lot of people though that are working and making a lot of money, and there's it with the equity markets at an all-time high, basically on a daily basis. There was an article on CNBC yesterday, and I think I posted in my video. There's more millionaires now, just based because of their 401ks and their retirement plans. Because of what the equity markets are doing right now. So yeah, there's a lot of people suffering, but there's also a lot of people doing very well. So I love the upbeatness of the channel. What my whole goal is on my channel, I'm going to divert just a little bit. I hear a lot that, people have no money and they're struggling and this and that. What my whole goal is to change your mindset. I want you guys to start thinking how you can make money. You can make money even in a down market. And we don't talk here daily about, we don't say you have to buy a house, you don't need to buy a house, but financial literacy, financial just knowledge, and putting a game plan or at least a budget in place can help you tremendously. So let's focus on ourselves right now and just do the best you can. So I'm sorry to divert on that, but so many channels are just doom and gloom. I want our channel to be, okay, let's help each other. Let's help each other understand the markets so we can go from that kind of broke mindset into, maybe wealth creation and wealth management at some point. So just wanted to divert off of that for 1 second. So that's it. That's off. I'll get off my pedestal now. So sorry.
You're good. Okay, so I did a poll here just saying, are you waiting until after the Fed meeting to look to buy? And it looks like it's a 50-50 yes and no. So it looks like some people are still on that fence there. And it's interesting. We'll see what happens with the Fed meeting, but I think a lot of people are still kind of holding out that there's going to be something that changes magically when the Fed has this meeting. And, I think we're both on the side that that's not going to happen.
Just pay attention. Yeah, just pay attention to the jobs reports right now as they come in, not just this week, next week, and following weeks. That'll give you the trajectory of forecasts of what the Federal Reserve is going to do. Because as the markets get weaker and weaker, I'm still, I hate to say it this way, I'm not a proponent. I don't think we're going to see a recession. I was a little bit different about 6 months ago, but I think a lot of things are just panning out pretty well right now. So we might just have a soft landing by the Fed.
Jason said, hey guys, wanted to thank you all for the knowledge you share. I've been learning a tremendous amount, not just about real estate, but about our economy too. Keep up the great work. Thanks, Jason. Appreciate you watching here. Banana scented a rat tail. That's an interesting username. Said, Dan, gas prices move by dollars daily, Frio.
Dude, I love it because if you ever watch my channel, I get pissed off every day about gas prices. One day I'll be going home, it's $3. Next day it's $4. It's like, what is going on? So sorry about that. But that person watches my videos because I rant and rave about gas all the time.
And Stephanie, thanks for being here. Said, just got our contract in Spokane, Washington. Awesome. And we have Oak Glen in Richmond. Cool. So we'll go ahead and put your questions here in the chat. We'll get to those here in just a second. I did want to mention there are quite a few things in addition to the Federal Reserve meeting that I think people are waiting for that I was curious to see, what is your perspective? So if in the chat you have perspectives on, your thoughts on the NAR settlement, how that's impacting you, what you're seeing, things with, maybe your concerns about the election and what that will do to mortgage rates as well, with home prices, mortgage rates. I'd love to see, what are you waiting on, or what is your feeling with the market right now? Because there's quite a few things that are kind of looming in the distance that we aren't really sure what's going to happen with in the future. And I think that's causing a lot of people to feel quite a bit hesitant. Understandably, right? And so some of those things I wanted to mention here in this article. Let me zoom in a little bit. The first is the NAR settlement. So for those of you who haven't heard of this, which I'd be kind of surprised because it's been all over the place, is basically the National Association of Realtors, or NAR, is a big, for lack of a better word, lobbying group. Is kind of primarily what they do, but a big organization of real estate agents. That's where the realtor term comes in. It's actually like a trademark name. It's not a legal designation. It's a name of a group. So basically, there was a lawsuit coming against NAR saying that they were basically facilitating in a form of price fixing by listing agent commissions on the multiple listing service, which is where agents are able to list homes and help buyers connect with home sellers. And so in this settlement, a few different changes got into place. One of those is that agent commissions can't be listed online in an attempt to not kind of price fix commissions, or what's the word that I'm looking for price fixing that is escaping me right now. Do you know what I'm trying to get at, or is that word just eluding me? There's another word there that I'm missing, but another thing that is in there as well is from the settlement, the judge said that there has to be now agency agreements with buyers. So basically what used to happen is an agent would work with a home buyer, and it would kind of be implied that you'd be working with that agent until you went under contract for a home. Then you would sign an agency agreement, which basically says it's like a contract between you and your real estate agent that defines, okay, this is how much the real estate agent is going to get paid. And kind of the customary thing has been that the real estate agent is going to be paid by the seller, and it's usually going to be around 3% to each real estate agent. And so now what this settlement has put into place is that throughout the nation, that agency agreement can't happen just when you're under contract. It needs to happen before you even start working with that real estate agent. Because what was happening is you had a ton of realtors who were going off of these basically implied agreements that, we thought we were working together. We don't have anything in writing. And then agents were also saying, hey, work with me. It's free to work with me, which isn't really true. Because working with a real estate agent, it's usually it's not an out-of-pocket cost to you. However, the agent's getting paid through the purchase price of the home. So you're still paying for the agent just in a more roundabout way rather than paying out of pocket. And so what's happening here is a ton of confusion. Nobody knows how this is really going to play out long-term for home buyers. We're seeing companies like Zillow going out and just saying, we'll do a per home agency agreement. I don't even know how legally Zillow's able to do this because there's not even including a commission cost in there as well. They're saying we'll sign a future agreement if you want to purchase the home. I don't know how that's legal. There's also a ton of real estate brokerages that are trying to figure out how long do we sign agency for? Is it for a week? Is it per home? Is it for 90 days? And then also it's making home buyers realize that, well, if the seller is going to not want to pay for the buyer's agent commission, your real estate agent's commission, then the buyer is going to end up having to pay for that. Well, most home buyers don't have 3% of the purchase price to pay for a real estate agent on top of their down payment and closing costs. And so you're seeing, I forget who it was. There was this company, I think it was one of the people who filed the suit against NAR, started a flat fee real estate company. So all of that, I think, is really confusing for a lot of people. And we don't really know how that's going to shake out in a lot of markets. So before we go on to another one or to the next ones, leave in the chat if you have seen this play out, or have you signed any agency agreements, and what did those look like? I'd love to hear where you're at and what those agreements are starting to look like, or the questions that you have around these agreements.
Yeah, I would love to see them too, because Alan just texted me. I just got a contract in, so I'll be calling those people. But I want to see what the new contracts are looking like, between the agents, because it's just weird. I don't even know how it went through, but whatever.
Yeah, how it's going to shake out is going to be interesting to see, because I think everyone's trying to figure out their own thing. And I've even had some friends of mine who are like, I'm starting this company based on this XYZ solution to this. And like, that's cool, but we don't really know what's going to happen in 6 months or a year from now, or how this is actually going to pan out in the real world when it's stress tested. I agree.
Kate
said, hey, what's your take on where real estate markets and rates will be in 2025? You want to try that?
Do me a favor. Do me a favor. Go back to the
there we go.
the FedWatch tool.
Okay.
We're going to use this to try to gauge us. Okay, so if you look over to this, if you look along the meeting date side on the left, you're going to see the dates. Okay, so let's put this in the context. This is where the federal funds rate is. At least gives us something to go with. Okay, so right now it's 5.25 to 5.5, and it's no longer on the chart there because they're expecting the rates to come down. But you could see, let's just go June or July of next year. Where is the most predominant section there? We're going to say at 3 to 3.25. Okay, so that's or 3 to 3.25 in those two ranges right through there. So that means most likely the Federal Reserve is going to cut rates 200 basis points or darn close to that. Okay, I don't think mortgage rates are going to go down that far. Here's my thought on that. I think the 10-year Treasury is going to get to about. I'll just come out. I'm expecting rates next year to be about 5.5, 5.5 to 5.75, and I've been there for a long time. But what's really thrown a curveball to me was the deficit that we have right now, because it's just the government spending too much money, issuing too many bonds, and that's flooding the bond market. And mortgage rates are tied to a bond. Okay, so there's way too many bonds in the system. So rates should go lower potentially, mortgage rates, but they're not going to. They're going to be sticky on the high side because the federal deficit. And this is where all that free stuff that the government gives away that I kind of complain about on a daily basis really comes and hurts us all. Because it's causing a national debt load that we don't need, and they got to do something about it because they just keep adding to this deficit. There's no cuts in the deficit at all coming. So what do we see right through here? This is the
look what I found was I was trying to do this on the last stream. So this is the blue line is the 10-year yield or the 10-year Treasury yield. And then the 30 or the red line is the 30-year mortgage rate. So this just goes to show, a lot of people want to compare the Fed funds rate to the mortgage rates to see, where are they going to be in the future. And we saw in that past chart that they don't really correlate quite well with each other. Versus the 10-year and the 30-year, these are effectively bonds that are competing against each other, right? So they have very similar yields, so very similar rates to each other. And normally, the spread between the two, you'll hear about the 10-year versus the 30-year spread. That spread is normally around 1.6 to 2%. And you can see there's quite a bit larger spread here since, beginning of 2022, largely because of the uncertainty and the risk in the market here. So when we're looking at rate projections in the future, we're normally looking at, what's happening, what do we anticipate to happen with the 10-year Treasury yield? And that's going to give us a better idea. We expect that gap to close. And like Dan was mentioning, you're trying to take a guess at that based on what we think is going to happen with inflation in the future, which is where Dan was looking at the CME probability to take a look at, okay, well, the Fed's expecting to cut rates. It's likely they're expecting inflation to be lower, and that should in turn show us lower mortgage rates as well.
Well, if you just use that chart, in normal times, we have the spread of about let's say on average 1.75 between the 10-year Treasury and 30-year rates. So right now, if you look at that, the 10-year Treasury is at, let's say 4. You add 1.75 to that, that means rates would be at 5.75 today. Okay. Rates aren't 5.75 today. So they're like, if you go back to the rate sheets that we have for today on the 30-year term, they're 6.3. Okay, so that's the kind of the disparity or the spread between them. They're way too high, and that's why it's really hard to predict, where mortgage rates specifically are going to go. But if we add a 2% cushion to it, that'll probably bring us in line. So let's say the 10-year Treasury that gets to 3.5, we have the 2% cushion. That'll give you a 5.5, and we should get to hopefully a 3% 10-year Treasury within 2025.
Yeah. Here, let me remove your little crystal ball here. Candace said, I'm in Cleveland, Ohio. Second baby is due this January. We have outgrown our two-bed condo with a toddler and a husband who will be work from home. So we really need more space, but not sure if rates will be cut more in 2025. I think we did kind of answer that, didn't we?
There's gonna be a lot of cuts most likely in 2025 because here's what you see when you're watching the news. What I try to do is put all the CNBC and all these financial channels in layman's terms for you. Okay, so that's what I try to do. What we're seeing in 2025 is, they're telling us the nominal rate and the average rate and where the federal funds rate should be and all this other stuff. Basically, what they're saying is when things stabilize, where should they be? So the Treasury yield should be about, so let's say 3.5, 3 to 3.5. And then you add the 2% to that. So just trying it when you start going through these numbers and you're trying to predict out, a year's time, it gets really hard. And there's a lot of disparities. Yes, this is most likely a complete guess. But we're just showing you based on prior historic data, where things are projected to get to. Now, all this could be thrown on its ear with any data, more wars in the Middle East, Russia doing some more stupid stuff, just things like that could really cause a hiccup in the economy and everything, believe it or not.
Let's see. I'm probably going to get back in the market mid-November. Do you think it will be a little bit better by then?
I mean, we're starting to see, Kyle, we do this every week. The constant theme is kind of like this. When rates get there, I'm going to buy. But again, here's what's happening. You're like that. It's like that Coke bottle. You're shaking it up and all the pressure is building in there. And then once the rates pop, everybody's going to go out there and start looking again. And you're going to have multiple bids and bidding wars and all this stuff again. I'm telling you, it's going to happen. And that's why a lot of people are saying, the housing crash. I'm like, if anybody's on here and you're actively looking at homes right now, you've been pre-approved or whatever, let me know how it's going. If you could just post, it's going well. It's hard to find a house in my price range. There's bidding wars. If we could have some, group participation, let us know how your house searching's coming. Is it really difficult or, what's going on out there? We're seeing a lot of bidding wars.
I will say too, I think one of the biggest kind of disservices for people looking at buying a home has kind of come in two phases. And it's been treating like buying a home is this investment that you're supposed to max out, making the most amount of money possible on. And I think this happened first when we saw a ton of appreciation happen over the past. Real estate has appreciated really well, particularly over the past 5 years. But even longer than that, normally people were able to buy a home. It was able to grow in value. They were able to sell it and usually get a pretty nice check when they sold. And so unfortunately, what ended up happening is people talking about real estate is this great investment. You're going to make a ton of money on real estate. And what I'm mainly focusing on right here, when I'm saying real estate, is a primary residence, a home that you live in, not an investment property. And so a lot of people have been conditioned to think that I'm going to buy a home and I should be able to make a ton of money on it. Well, that is usually not true. The main benefit of buying a home is because it's usually mathematically better to purchase than it is to rent, which I can illustrate here in just a second. The other stage of this is that now there's this new level of that with the interest rate, I have to maximize my interest rate so that this home becomes an investment that I make the most amount of money possible. And I think that's really doing a bit of a disservice to people who are looking to buy. Because if we think about investing in any sort of market, let's take like investing in stocks, which is probably the most common or accessible example, is that there's a really common saying in stock trading or investing where it's don't try to catch a falling knife. And the theory is like, okay, if we're looking at stock, like Dan was talking about Bitcoin earlier, well, if I'm looking at Bitcoin and I say, I'm not going to buy it, Dan, I'm not going to buy Bitcoin until it gets a little bit lower and a little bit lower and a little bit lower. And if you look at research on stock trading, it is almost impossible to purchase at the bottom and then sell at the right time. Timing a market like that is almost impossible to do. And even when you compare expert stock traders, expert hedge fund managers to literally the flip of a coin, they tend to be pretty equal. The best, most sophisticated stock traders tend to have around a 50%, maybe a touch higher, maybe 50 to 60% win percentage over just, a raw, flip of a coin. So I think a lot of people are trying to become experts and time things really well, when in reality, it's just almost impossible to do. And if it was possible to do, you certainly wouldn't be sitting and just buying a home. You'd probably be a multi-billionaire if you were able to predict markets in this way. And so I think that's been a bit of the struggle that's been happening with kind of the rhetoric around buying a house, is that I have to become this super savvy investor by timing the house price right, timing the interest rate right, rather than saying, what can I do with what's within my control? I'm buying a house because I don't want to keep renting and paying rent, paying rent. I also want to be able to have a lifestyle change that comes with buying a home. And then if the opportunity presents itself to get a deal, great, I'm going to do that. If there's an opportunity to refinance at a lower rate, then great, I'm going to do that. But trying to time things in the right way isn't going to pan out for most people. And just to show like a mathematical example of this, in the loan comparison calculator I have, let's go through an example of, let's say we're looking at a $450,000 purchase price, which is around the median home price in the US. Let's take a look. Let's say you got a loan with an 8% interest rate, which is higher, almost 2 points higher than it is right now. Well, all the way at the bottom, I have a rent comparison. So in this comparison, it's taking a look at appreciation on average of 4%, which is a little bit low actually, a cost to sell of 6%, and then assuming your taxes and insurance are going to increase every year by 2%. So if we take a look at this, let's take a look over, let's say 5 years. Oops. Why is it giving me a struggle right now? Okay, we're going to look at 6 years then. The cost for this loan, so if we're considering taxes, homeowners insurance, the interest, the cost of the loan, the appreciation gain, the cost to sell, the net cost of owning that home after 6 years would be $190,000. Now, comparison, a comparable rental payment would cost us $203,000. Okay, so not a crazy huge difference over that period of time. Again, that's with an 8% interest rate. And so the difference here is not that you're not become super rich by owning a primary residence. It's that it's better than renting in most cases mathematically. So if we even take this down to where we see rates are right now, which is about 6.4 on average, that becomes even better. The cost over 6 years is $148,000 versus renting of $203,000 over that same time period. So I hope this just kind of illustrates. I know a lot of people have, yeah.
Where are you getting the rental, the 2625 that you had in there is the rent equivalent?
I am just putting in the, let me see, it is pulling this in from, I'll jump back here.
Your back-end calculators have a ton of data, so I just didn't know if you had something plugged in for the state and all that stuff.
No, it doesn't pull in state data, but so the mortgage payment would be $3,700, and I'm assuming that a rental would be somewhere around $2,600. Now, you'd obviously have to play with this in your market. The hard thing is what people do is they try to compare going from a 1-bed rental to a 4-bed home. Well, if you're looking at comparing renting versus buying, we have to look at the same level of square footage, homes, baths, and things like that. Because of course, like it's like if I lived at home for free versus buying a home, living at home is always going to be cheaper because it's $0, right? But I need to compare if I'm looking at renting versus buying. Well, either I'm renting a 2-bed home or I'm buying a 2-bed home. That's a true comparison. And almost always purchasing is mathematically a better decision than renting. And that's all I want to illustrate here is that that's the main goal with purchasing, is not because you need to time everything. It's really stressful to feel like you have to time every single thing, get the best rate, get the best price in the best market, and do all of this, insane guesswork that's almost impossible for somebody to do, when the only goal here is just to beat out the alternative, which is renting. And again, mathematically, it's almost always better to purchase than to rent. Okay, I'll get off my little monologue here.
I love it, buddy. I love it. Usually I'm the one doing all the talking. I like just sitting in the background today.
Holly Brown said, I just got an offer on a house in Louisiana, lower than we wanted. So we're waiting on rates to drop before we buy. Just got an offer on our house.
If you
Oh,
guys,
interesting.
what's the magic number? If everybody can just put in a something, everybody keeps saying, I want the rates to drop down too. What's that number? I'd love to know. Like my ideal in my mind, I think as soon as we hit 5 something, it could be 5.9999999. That might do it. So what are you guys thinking out there? If you could just plug in, 5.5, 5.9, whatever, they're not going to go to 3.5, folks. So if you're waiting for 3.5, just rent, because you're probably never going to buy in my lifetime. 5.25, interesting. Okay.
Someone asked, how do you think the election results will affect the housing market? I wanted to pull up this article that we came across that was interesting, showing historically what's happened with different election cycles. So the starting rate for mortgages in November to December, and it shows the change. I know it's a little small. That's probably better. So I want to show you here the differences in rate change over effectively, 2 months. Sometimes it's nothing. And then the biggest swing has been around 0.8%, looks like is the highest. And then over the past couple of years, we saw 0.04, we saw 0.5%, and then we saw 0.03. And the hard part in here is what none of this data is showing us is what's the other data that was happening during this time. What was happening with inflation, what was happening with the jobs reports specifically is going to have a really strong impact on mortgage rates, not just the election. And so, again, I know a lot of people kind of have this fear of there's going to be the election. We don't know. There might be this huge swing. Usually mortgage rates are more dependent on what's happening with job numbers and inflation data, especially because of where they're at right now versus just what's going to happen with an election, because a new election doesn't immediately change inflation, and a new election doesn't immediately change jobs report data all in one, swoop quite like that. And in 2 months is not a big enough change for an administration to have a large impact on inflation or jobs data as well, which is primarily running or pushing mortgage rates in each direction. So I don't think that's too much of a concern, and certainly not something that can be predicted on what's going to happen. Okay, Dan, we've got some 5%. We have a 5 to 5.5%. We have another 5.5%. Nat Kakuna says 2.67 on a current home. So we won't see that again. Do they have you beat?
I was surprised. Yeah, I was surprised to. Oh no, I got it. I got him beat. And Nat, you got 2.67. They go in eighths, so it has to be 2.6. Oh, you're right, 2.675. So they got to 6.625. So that's the same rate I got. Good job, man. Good job. I was surprised of all the low fives. Interesting. Very interesting. Okay. There's no right or wrong answer. I don't know if I don't think we're going to see fives in 2025. That's just my thought behind it all.
Yeah, I'm assuming we're going to touch below 6, but probably stay in that range, 5, 8, probably for a while. There's probably going to be a lot of people writing loans at like 5.499 with like 1 point.
99999.
To make it seem.
You ever see the gas station? The gas station is the only place I know that goes out like 3 decimal places. You ever see the gas price? It's 4.29, and then on the top piece,
and it's like 9
might be
tenths.
another 9 or 99999. So it's like whatever. See, I got to go on the gas prices again.
Right.
Got the gas thing. You got me nailed, buddy. You got me nailed.
Just to make it seem a little bit better. Jason said, my wife and I locked in 2 weeks ago with a new build house at 5.99. There it is. 5.99 and 9 tenths. They offered a free rate adjustment if it goes down by more than a point. How much is a point usually? Well, in this instance, they're talking about a percentage point of the loan. So I think they're saying a rate adjustment if it goes to 4.99 as the market rate is what I would expect there. Cynthia said, reserves are my trouble. For qualifying, I'm assuming is what you mean. You need reserves to qualify.
They might be buying a multi-family property. That's usually in most cases when you need reserves. So it'd be interesting if Cynthia, if you could email Kyle or myself and just let us know kind of the situation. Kyle, I know Kyle was working on, you and Alan were working on a website for people kind of in her situation that's that maybe got a house or put a house under contract and then they just hit a brick wall with their lender for some reason. So Cynthia, I don't know if you've
Yes.
hit a brick wall with the lender, but love to assist if we can.
Yeah, we were working on a like a second opinion thing where you basically could get a second opinion on your mortgage. We don't have that fully created yet, but what I'll do is I'll just put in my email address here, and feel free to just let us know what's going on, and we can see if we can help you out there. Because with reserves, we can either look at things like retirement accounts, 401k, IRA, if you have access to those. And then also a gift. A gift can't be used for reserves, but if a gift from a family member, for instance, can cover your down payment and closing costs, then the money that you do have can be counted as reserves. So that could be something, and maybe you've already explored those options, but if you'd like, feel free to reach out and we can see what we can do there. Let's see. Home prices are still high. My real estate friend said they're still having bidding wars and houses are selling in less than a week. Yes.
That's what we're seeing here.
Boston.
I have hundreds of pre-approvals out there, and while we're live, I just got a contract in. So, but yeah, there are bidding wars. I mean, there is bidding wars every day, and that's when I hear, markets are real estate's gonna crash. It's like, well, it's not going to crash. I don't know what I could say to kind of get it through everybody's head. The market isn't going to crash anytime in the near future right now, folks. Okay. So I think you can ask any questions you want to know why. We'd love to answer those if you want.
And the majority of people we're working with too, Dan, aren't, they're not in San Francisco. We're not doing, 80% of super competitive markets. We work in a lot of like Midwest type areas, or somewhat smaller metros, and still people are running into bidding wars and a lot of competition. Rakesh, good to see you again. Hey guys, always appreciate you. Job revisions every month always happen to be down. For example, the JOLTS job openings last month was a beat, then revised down to be a miss. Is the data rigged?
Well, it was like the 800,000 job thing. It's like, well, 800,000. I think. Do you remember the article that came out? I think it was last week or something. I did a video on it. There was two like investment companies really took a deep dive into it, and they're like, "There's 800,000 jobs missing," and it kind of just went right through the right. It didn't even, the markets didn't even react. It was the weirdest thing, because if you miss on the employment data by 10,000, the markets go crazy. Then they come out and say 800,000 jobs are basically just not there that we reported that were there, and the markets just kind of skim right past it. It's like it's odd. But yeah, Rakesh, great comment, buddy.
Gary said, I'm looking to buy in South Carolina. I have $150,000 as down payment. Ooh, that's a sizable down payment. Currently getting 4.6 on that. I'm assuming probably in a high yield savings account, CD, something like that. I've been waiting, thinking prices may fall, but they seem to be going up. Am I losing money by waiting? This is a hard one to answer, because it feels like there's no way that we can answer this without somebody. Wait, hold on. Let me cover myself. There we go. Magic crystal balls on my side this time. Thank you. Yes.
I was trying.
Oh, wait, it is hard. It's hard to.
It feels
to figure
weird
because I can't see where it's at. Oh, it's so stupid. I'm just really proud of how I could get this little curve thing going on behind it.
Yeah.
Are you losing money by waiting? Nobody knows the answer to that. I am of the opinion, and Dan is as well, we're seeing real estate on the in a long time horizon is appreciating nationally around 4 to 6%, depends on what market you're in, over like a 50-year time period. And so for me, when I'm considering buying a house, I'm not looking at what's going to happen next year or 3 years from now. I'm looking at what do I think is going to happen in 10 years. Historically, the data is showing me that it's going to appreciate over time. So is it going to beat what you could get in the market, I don't know. It's really difficult to say. But on average, I don't. I anticipate real estate to go up in most markets. So I wish I had a better answer than that for you, but it's really tough to say.
There's a lot of comments on the side of, if you want to have an area that housing prices and inventory is growing way too much, and it's a scary market, it is the Florida and Texas areas, and Florida mainly. Texas, a lot of people are complaining about Texas and this and that, but if you look at the Austin data, I mean, if you really take a deep dive into it, it's not dismal. The concerning areas are Florida, like Jacksonville, areas like that have way too many homes, but there's more issues than just that in Florida. You have, like, I have a place down there, and we just got hit with a huge special assessment that I had to write a check for, and it was 5-figure. It was $60,000. Okay, so probably shouldn't tell you guys on here, but it's $60,000. Okay, the insurance went up. The association, a lot of people can't do that. So those areas are going to be like, okay, we can't afford it. We got to get out of here. But if you look at it, that $65,000, assessment I just paid, they put in a new roof, all the new balconies, a new pool, a new this, a lot of that is put into the property. So my property value long term is going to go up. Short term, I'm getting really hit. Long term is what I'm looking at. Where's that property going to be, 5-10 years from now for, even my kids. So that's what I look at. I'm a little different stage of life than you guys are, but what a lot of people can't, you got to figure out, is it going to be my house, or is it purely an investment for you? And if you just want an investment where it's going to appreciate and everything else, you need a financial planner. If you want a house to live in that you can probably most likely make some money long-term in, that would be a house. But, too many people treat it as like a stock or a commodity that you can just kind of, buy and sell to make money. It just doesn't work that way. So if that's what you're looking to do, God bless you. But most people are looking to buy that house to live in. Like the young lady that just came in earlier. She said, we're having my second kid in January. We outgrew our condo. We need a little bit bigger place. Okay, so that's what those are. So, but yeah, there's the poster children is Florida, and Texas. They're talking a lot about Texas crashing, but there's still, the data's not there, and I consider a crash 30%. Just so you guys know. So that's my take.
Stephanie said our agent saw the NAR outcomes coming and had to sign a buyer broker agreement, and we factored the seller BB comp into our offers. Do you know what the BB stands for? The buyer broker comp?
Yeah, maybe. Buyer broker question. They did B/B on the one side, and then they just abbreviated it in the next sentence.
Okay. Yeah, I know a lot of agencies were doing that. Even before the settlement came out, they were starting to put in those agency agreements just to get them going. That way, day one of it being enforced, they weren't scrambling to try to figure out what was going on.
We did have a closing Friday, because I remember I had to go to the physical bank, Serve Bank. They were having a picnic, and I had a closing going on, and the realtor called and said it was like split commission. The seller's paying a portion, the buyer's paying a portion, and something. It was really complex. Usually it's just, here's the buyer agreement and all the compensations, listed right there. It's basically paid to one person and broken up. This one was like you needed a calculator to figure out what percentage went to whom, but it's still closed. So it's just going to complicate things, but I don't think it's really going to make that huge of a deal in the overall market. Yeah. It will be changed.
Well, even my dad is a real estate broker, so he oversees a team of, I don't know, 100 or so agents. And on the contracts that just came out and got vetted by the board of realtors in our local area, there's like 4 boxes that list out, who's paying commission and who it goes to. And this is how easy it is to mess up the commission side. One of the agents, there's 2 boxes next to each other. If you put one in one box, it says, the seller is going to pay the buyer's agent, X amount, let's say 3%. So normal, that's how, or customary is the way it has been normally in most transactions. Well, if you put it in the box below, which this person accidentally did, it ended up saying that the real estate agent owed the seller's agent 3%, and they were going to have to pull that out of their pocket to say it. So just two little boxes with tiny little text goes from either you're getting paid or you're losing money as an agent. And so I think this is all going to have to clear out with all these weird things that are happening to make it make sense, because effectively, my dad looked at that agent and said, you just agreed. You just signed a document to pay them 3%. Is that what you want to do? So it's going to be weird to see how this pans out. And someone mentioned too, Maddie said, a lender in Greater Seattle told me a few days back that the NAR settlement is basically a non-issue here. Agents are still splitting commissions here. Buyers are not typically paying out of pocket. And I have a feeling that what's going to happen is there's probably going to be, I think there's going to be a lot of companies that are going to try to rise up to create like flat fee services, or I know some people are trying to do like software service companies and trying to reinvent the whole wheel here. What I imagine is going to happen is, with so much complexity, it's probably going to go back to a very similar way that it's been done, just because I think it's what people are used to, and because prices kind of already have that, that commission structure baked into the value of the home, because so many transactions happen with a real estate agent with that 6% included in the sales price, that if we eliminate that, then theoretically home prices across the nation should drop that amount, right? They should remove the baked in commissions. And so it's all just a mess.
Yeah.
I have no clue what's going to happen.
That's why we keep trying to get realtors on here to explain it. And I've talked to several, and some are like, it's going to be terrible. And then others are like, no big deal. So it is weird who you talk to. It's either, a huge issue, or they're like, no, it's not going to be anything at all. So we'll see how it pans out.
Tira said, hey guys, if your government debt comes up in CAVers, but it's almost paid off, in other words, child support arrears, does that disqualify you from an FHA loan? So CAVers, for those of you who don't know, it's a report that's pulled on government loans. So FHA, VA, USDA, and basically it's a credit alert something verification system, credit alert interactive voice.
Oh, what CAVers means? I don't know. I've never known.
I forget what it stands for. Credit alert verification reporting system. I was somewhat close. So basically it's a report that shows if you have any owed like federal debt. So think of like federal student loans. If you have any tax liens, those are going to show up in CAVers. And then also child support will show up in there as well, because it is effectively federal debt, even though we don't really think of it that way. So basically you can't get a government loan unless your CAVers is clear. The only way to get a clear report is to either have those items paid off, and the account is clean, or it's in some sort of payment plan agreement. And so if it's almost paid off, what I would do is just, if you can, go ahead and pay it off. That way that CAVers report can show up clear, because you won't be able to get a FHA loan with it. If you're running into issues, if you still can't pay it off, maybe the balance is a little bit too much to pay off, then a conventional loan won't run a CAVers report, and that may work for you. Hector, hello guys. Love your content. Closing on a home in 8 days. Haven't locked in my rate yet, but I have until the end of the week. Would you wait or go ahead and lock in?
You know how many emails? I should show you my screens. I got two screens going on. I don't know if you guys notice I'm going like this all day long. I'm getting emails, texts, phone calls, and everything about exactly this. There's tons of people looking to close, and they're telling us this. I'm going to put all the information into your lap so you can make the call. Okay, so here's what's going on in the next 48 hours. Tomorrow, ADP is coming out with their jobs report. Okay, that might be a market mover. I think there's a couple other pieces of information coming out tomorrow as well. Friday's a huge day. We have the federal government's report on jobs. We have actually the official unemployment rate will be posted. So all that information is coming out in the next 48 hours. It will be market movers unless it comes in dead as expected. So if you go to any economic calendar, you can see, here's where we were, here's the expectations, and here's where it gets posted. If the numbers come in, if the jobs report numbers come in bad, meaning there's a lot of people that didn't get jobs, the unemployment rate ran up, and it's out of the ordinary, or it's a little bit more than expected, rates are going to come down, and they might come down a decent amount. However, on the flip side, if the number comes in a little bit better than expected, rates are going to go up. And here's my thinking. It's kind of like gas prices. I'll go back to those gas prices. When you see oil prices, because gas was made from oil. If you see oil prices, go up one day, on your way home, I can guarantee you gas prices went up. Okay. If you see oil prices go down while you're at work, when you go home, gas prices are going to be the same. They might go down a little bit the next day and a little bit more the next day. So you understand what I'm saying here? If the news comes in bad, rates are going to come down, but are they going to come down substantially? I think there's a more of an upside risk than a downside win, I guess is the best way to put it. But that's the data that's coming in that I'll let you know that, you got to pick, if you think the jobs report's going to come in as expected, is worse than expected or better than expected, and then kind of go with it. I'm a 50-50 right now. I don't know how these numbers are going to go. The unemployment rate should increase because of that data that came out. That should be basically like a gift to us, is saying, okay, the unemployment rate is going to go up because that unemployment data went, up so high last week when those 800,000 jobs come missing. But for some reason, the markets aren't adjusting to that. So I'm really I don't know. I don't know.
I give you
I hate to say it that way. Yeah.
a somewhat simpler opposing perspective is that I think for people who are looking at buying right now, for people who have bought in the past, I would say 6 months to a year, and who are buying right now, I think you should probably expect that you're going to refinance within the next 3 years. Sometime within the next 3 years, you're going to refinance. I would just take that as a given, because with rates where they're at right now, and where we see inflation and where we see rates going, it's a high chance that you're going to be refinancing within the next couple years, because we're expecting rates to continue trending downwards. Again, with hoping there's not some war or something that unexpected throws the world into chaos again. So with that being said, if you're already planning on, hey, there's going to be a refinance here in the future, that refinance should be, the expectation would be, let's say it takes your rate down from a 6.5 down to a 5.5, right? That's a pretty big drop that would happen with refinance. I would be less concerned about, in the next 8 days, how do I squeeze out the most, because I already know I'm going to refinance here in the future. So let's say, for instance, just for easy numbers here, let's say your rate right now is a 6.5, and you're like, well, if in the next couple of days numbers change and now it drops to a 6.3875. Okay, well, if you missed the opportunity and you locked at 6.5, it's okay, right? It's okay to have that rate for the next year and then refinance when rates drop even further down to, let's say, 5.5 or high 5%, right? I wouldn't try to spend so much energy trying to squeeze everything right now, because it's a long-term play. We're looking at refinance opportunities in the next 3 years, not just the next 3 to 8 days. So if I were you, and I'm saying I'm looking at closing in 8 days, if you like the rate that you have, I personally would go ahead and lock it, get everything squared away, and then move on from this transaction, and then be looking at what's the next big, meaningful rate change opportunity to refinance. Because it's kind of the same thing with, I think a lot of real estate kind of relates to, buying your home relates to investing, where, it's kind of when people talk about, millennials don't have money because they spend it on avocado toast or Starbucks or something. It's that's not true. Small money things don't have big impact, right? Small
what?
changes.
When I went by Panera Bread this morning, you were sitting drinking a coffee and had your walk toast.
Well, I took out a second mortgage to be able to go there, Dan.
Sorry, you're on a roll. My bad.
These small changes don't have such a big impact, right? So I would be more concerned about where am I getting the most bang for my buck? And that's going to be in big changes in rate. And I'm going to refi and save a lot of money then. I'm not so concerned with tiny little fluctuations. And I think that's where people are getting a little bit stuck, is it's kind of this like you go to the grocery store and there's like 20 different types of ketchup. And all of a sudden now I'm picky about my ketchup. When in reality, if someone just handed me a bottle, I wouldn't think anything of it. Right. And so I think it's the same thing with rates, is it's how do I get the tiniest little change to where I want it to be? When in reality, it's like, let's focus on the big picture changes are going to have much better payoff and less stress than I think these smaller ones. So I hope that that helps
Hector,
with the mindset of it.
don't pay any, I guess the bottom line, don't pay any money to buy down your rate. Don't spend a nickel. Please don't anybody on here, please. And I mean, unless you're using seller credits or whatever, I wouldn't be a proponent of using, doing a buy down, or especially a permanent buy down on my rate, knowing when the Fed basically just laid it on the thing saying we're cutting rates. Okay.
Yeah.
There is a few in here. Stephanie Dunn just asked a question about rates, cuts, and things, and I still don't think we're getting through.
Stephanie.
It's like the last question there. It's way down there. We can get there if you want, but I still think people are still when the Fed cuts rates, mortgage rates will not be affected that day. They won't be affected. They're not directly affected with the Fed anyways. So kind of, we were talking about this earlier, Stephanie, is basically when the Fed has already projected or already forecasted they're going to cut rates. So the mortgage rate environment is already coming down because they know that's coming. It's kind of like Kyle's analogy. If Apple came out and said, our financials are coming out next week and they're really bad, the stock's going to tank right there and then. They're not going to wait for the earnings to actually come in and be published. They have already told us that they're going to be bad. They're telling us, the Fed's telling us they're going to cut rates. So the rate environment is starting to come down because of that. So the day the Fed cuts, mortgage rates might go up, believe it or not.
Yeah.
Because we're waiting for future guidance. So if they come back and say, well, you know what, the jobs report's coming in really nice right now, and inflation's starting to tick back up, we're not going to cut anymore. The whole market will change again. So it's kind of like throwing darts on a moving dartboard. You just have to concentrate the most you can. So, but yeah, this is what I try to get through people on a daily basis is when the Federal Reserve cuts, that day mortgage rates are not going to change, most likely.
I will say, I just want to add in clarification too. What we're not saying is that mortgage rates aren't going to continue to go down. They're going to go down because inflation goes down and we see different jobs reports data, not because the Federal Reserve changes their number. Tira said, the reason for my saying low 5% is because I want to use DPA, which will make the rate go up. Yeah, a lot of down payment assistance programs do have a higher rate. If you are looking at DPA, I would also, if you haven't already, and you may have, because I know you're here on these streams quite a bit, look into the grant programs that we have. So we do have on our website here, if you go to tools and then grant finder, we have 3 grants that go up to just above $7,300. And only one of these has a slightly higher rate. And Dan, it's like what, 1/8% higher than normal, somewhere around there.
Well, during our consultation with that lender at that time, they said the rate can vary by about 0.28. Where the 2.8 came from, I don't know, but that might be. Pull up can you pull up my site real quick? Because I have it, I try to put it in there is findable, if that's a word, findable as I can. So you can also go to the rateupdate.com and it's right there. We have 2 grants and it goes to the same place. It goes to Kyle's landing pages, but there's a national grant. And then we also have one in the Chicagoland area. So if you're anywhere in Chicago or the surrounding kind of suburbs, there's a $10,000 grant available. You have to check there to see if you qualify. But you see, even on my site, I think if you click it, you go right to Kyle's landing page.
Hey, Daniel, thanks for joining us live here. I wanted to mention here too with this Tira. With the down payment assistance and there's a lot of loan programs that I kind of view more like a bridge. And I know a lot of people, they want to get a loan and they want to forget about it and they want it to be the best possible. But with the way markets work is that, especially with like refinancing, is anytime we can get cheaper debt, that's the goal. And we're just trying to use all these different types of mortgages and programs to figure out how they fit into your buying strategy. And so, for instance, what I might consider is with something like a down payment assistance program. If I was in your situation, I probably wouldn't wait on rates to lower to then get a down payment assistance program, because then with lower rates, the odds are the home price has already gone up in value over the time that I waited, and there's more competition because rates are lower, more people are going to jump into the market. My thought with down payment assistance programs, for instance, is more that I'm using it like a bridge. So for instance, I might purchase the home now with down payment assistance, knowing that the rate's going to be higher than I want it to be right now. Of course, don't take on a mortgage that you can't afford the monthly payment on. But then what I would do is, expecting in the next, let's say 5 years, rates to lower, I would refinance out of that down payment assistance program. So I basically used the features of that program, then refinanced into cheaper debt when the time came. I think the same thing of like, there was a client I worked with once who they had a bankruptcy like 6 months ago, which is almost so difficult to get a mortgage for because there's very limited programs. So I was like, what we can do is get you into, they really wanted to buy a house. So I was like, we can get you into this program that does a 1 day out of bankruptcy, but the rate's going to be really high, just as a heads up. So their rate was 9%, right? And I said, okay, you're going to be at 9% because no one else is going to lend money to you with, having a bankruptcy so recently. So what's going to happen is then when you get your bankruptcy seasoning of 2 years, so in a year and a half, you'll refinance to a market rate. You can then qualify for a normal loan and get a much lower rate than that 9%. So the 9% was effectively just a bridge to get you to wait out the time period that you needed to get to cheaper debt. And so that's how you try to structure a mortgage, is to use the benefits of it and then refinance it to something cheaper when it's available. Let's see. Rakesh was in here as well. Rakesh said, I would do the opposite if you're able to take a higher rate and get money towards closing. You can calculate a break-even point if it makes sense, since high probability of refinance within 3 years. That's absolutely an option as well. And then we have,
he knows what he's doing. So Rakesh, good job.
You've got at least one vote for President Dan.
My man Ed. He posted, he asked a question yesterday. I think that was you, Ed, and I answered in regards to the DSCR. I think Ed posted on one of my videos, does the DSCR program, does that loan show up on your credit report? And I talked to 4 or 5 lenders, and in most cases, yes, it does. So if that was you, Ed, thank you so much. See, I do know what I talk about, and I do answer the comments on my YouTube channel.
I do want to show you, for those of you who have a question, because Dan and I we stream on both of our channels, so there's more questions than you probably see in the chat. And so we can't get to every single question, but what you can do is if you go to whenthehouseyoulove.com and then click I have a question first, you'll be able to type in your question, and then we'll give you a video response back. So for a video response, it normally takes just under 2 days to get that back. If you want something quicker, just shoot us an email and we can send you a question back. But it's a really great way for just, low stress, low pressure. You have a question and we'll be happy to help out with that. And then if you're ready to get, whoa, I got a lot bigger there. If you're ready to start on I wasn't prepared for how close I was going to be. If you're ready to start on a pre-qualification, what you can do is schedule a call with our team at whenthehouseyoulove.com. We work in all 50 states, and so you'll schedule a call with either Alan, Dan, or David on our team. Each have over 20 years of experience in mortgages. So they'll be able to answer your questions and help you figure out which is going to be the best loan for you. I know a lot of times people feel like they have to know the answer of the loan that they want. They have to know, like, I want an FHA loan. You don't have to know the type of loan that you want. That's what our job is. Our goal is to help you figure out what's the best loan to meet your goals. Like Tierra was mentioning, is like, what grants can we connect you with? On all of the calls, we'll run our grant finder to see if there's any federal money available for you to take advantage of that can help with your down payment or closing costs. So schedule a call. It's free. There's no obligation with it. We don't do hard, aggressive sales techniques. We're not going to like call you all the time and text you all the time. Our goal is really just to be, to work alongside you, to be an advisor for you in picking the best mortgage, getting pre-qualified as easily as possible. That way you can go shop for homes whenever you would like to. So again, whenthehouseyoulove.com. And thank you all for being here. We'll be doing this live stream again, same time, same place next week, Wednesday, 3:30 Eastern on my channel and Dan's channel, The Rate Update with Dan Frio. And thank you all for being here. We'll see you next week.
Thank you so much. Take care. Have a great week.